Securities attorney Laura Anthony is the founding partner of Anthony LG PLLC and works in corporate and also securities and business transactions. And she's here with us today to give people some information about going public. This is a mystery, especially to a lot of young companies that have a dream of having an IPO someday. So besides an IPO, what are ways that companies can go public?
Well, good morning, Jane. But there are generally three ways to go public. A traditional IPO, initial public offering, a reverse merger, or a direct listing. Where an IPO always involves a capital raise, a reverse merger and a direct listing are just going public transactions. And so the capital raise must be bolted on separately. The well-known SPAC, Special Purpose Acquisition Company transaction, is really just a reverse merger, but the public company being merged into has cash, adding that capital raising aspect. However, in a SPAC transaction, there are usually a very large amount of redemptions by the initial IPO shareholders, and they may reduce the cash by as much as 90% or more. I've seen 99%. Usually, the private company in a SPAC transaction will negotiate with the SPAC so that there is a minimum amount of cash at the closing as a precondition to closing. And that cash can be derived from reduced redemptions or new capital transactions, such as usually it's a PIPE transaction. In a direct listing, the exchanges do allow for a concurrent capital raise by a company, though companies should keep in mind that the direct listings initial listing standards are about triple those for an IPO. And as such, a direct listing is really an option for a more mature company. On the other hand, a direct listing onto OTC markets is not only achievable by smaller companies, but is the more common way to go public than an underwritten public offering. But those are the three ways: IPO, reverse merger, and direct listing.
So interesting. And just hearing you talk, I'm all of a sudden, and I knew this anyway, but knowing how important it is for companies to have a lawyer to guide them through this process. It's so complicated,
right.
And a lot's changed. And the market for IPOs hasn't been great lately. I'm here at the NASDAQ. It's not what it was a few years ago. What are you seeing in terms of IPOs and just capital raise in general?
Well, we certainly aren't seeing the same level of activity as we did in 2021, which was huge, and even the beginning of 2022. But we are still closing transactions. They just tend to be a little smaller. In the past month alone, my firm has closed 2 IPOs, Sila Technologies at $15 million and Trio Petroleum at $6 million, as well as several PIPE transactions, including, for example, there was a $4 million transaction into Reliance Global and an $8.4 million transaction into Namara Medical. And really also the reverse merger market is alive and well. A lot of companies, especially those that don't have a real immediate capital need, are using this as an opportunity to go public so that they're there and can take advantage of any market upturn, which will inevitably come. And also keep in mind, an IPO doesn't happen overnight. It can take 6 to 9 months, and markets turn quickly. So we still have a huge pipeline. For example, our firm has a pipeline of 20 right now, and they're flexible in both their timing and the amount of capital needs, so that they can take advantage. But we remain optimistic, and the bankers I work with remain optimistic.
Mm-hmm. And the last time we talked, you mentioned liquidity, the restrictions on insiders and affiliates. So can you explain a little bit more about that?
Certainly. Well, an IPO or any other going public transaction generally involves a capital raise, as we just said, and it utilizes an underwriter and key or anchor institutional investors. The underwriter always requires affiliates and insiders to sign lockup agreements, and they may be for a minimum of 6 months, but often are as long as 12 months. And there are plenty of reasons for this, but mainly is they don't want insiders competing with the open market by adding selling pressure to a stock price so that, the stock has a chance to find its legs and perform. And importantly, when an insider sells stock, they have to file a form with the SEC so the public knows about it. And it's just a bad look if right after you go public, insiders are selling stock. Insiders are expected to be the strongest believers and the largest proponents for a company. They also have insider trading and inside information rules that they need to comply with. But on the positive side, Where an IPO is not an immediate exit for an insider, it offers a longer term exit and the potential to build wealth, real wealth creation. It also provides for succession planning. With the use of stock compensation, new C-suite executives become invested in a company and its future and can eventually take over operations, allowing for better exits for the founders and initial management team.
Okay, Laura, thank you so much. Great information for any new company or somebody who's thinking about, exploring an IPO or some kind of public market. So thank you so much for all your information.
Thanks, Jane. Great to see you again.
Yeah, you too.